Hi everybody, thanks for listening today. My name is Saul Miller and I am one of the fund managers that oversees the Nedgroup Investments Balanced Fund. This is the historic performance of the Balanced Fund. I'm just going to take you through what has worked and what hasn't worked over the last 3 months and the last year. So since the election that just passed, it was a positive result that was very good for SA assets. So we saw a strong rand and we saw a lot of locally or domestically exposed shares performing particularly well. So you'll see over the last 3 months, a lot of those sectors contributed to our performance, whether it was banks and financials or whether it was SA bonds. Unfortunately, the strong rand detracted from our foreign holdings. In addition to that, we have quite a bit of exposure to European shares, and post the snap election in France, we saw a lot of those European shares coming under pressure. Post-month end, we've actually had a nice recovery, and you're obviously not seeing that over here, but hopefully you will see that in the next update. If we look at a slightly longer period of 12 months, you will see very much similar themes playing out here, where domestic sectors have done well and offshore also would have contributed here, given that we have exposure to our offshore portfolio over a full year. With that, I'm going to move into our economic overview. I just want to start with a slide that reflects on some of the valuations for SA and global territories and countries. So if you look at the top, you'll see that the all share is still trading at quite a discount to its long run PE of the last 10 years, but the all share is quite a mishmash of different sectors and those weights have changed quite a lot. So it's a bit more instructive to look at homogenous sectors within SA. And the one that I'm showing you here below is SA banks. And what you'll see is there's been quite a re-rating in SA banks. So, and not just SA banks, in fact, that would apply to a lot of domestically exposed sectors. A lot of that substantial risk premium that we saw in SA assets prior to the election has actually been taken out, and they're now trading a lot closer to their long run or their 10-year averages. If we look at China, you can see that China is still quite cheap. That is not surprising, given that the Chinese economy is certainly still struggling, especially if we look at current or recent economic data that has come out. If we look at other regions like Europe, the UK, Asia, Japan, valuations are actually pretty much in line with where they've been over the last 10 years. And the US still looks quite expensive, and that's particularly due to some of the large cap tech shares in the US that are quite expensive, which you can see in the bottom row. In addition to those shares being expensive, expectations for earnings from those shares are also at fairly frothy levels. You can see quite a long run history here, and you can see that earnings are expected to grow off a high base at levels even above where they were in the tech crisis or the tech bubble of 2000. So the worry is obviously that these expectations don't get met, and at these kind of valuations for these large cap shares, you could obviously see some underperformance in the S&P, and that's obviously a risk that we are worried about and have been worried about. One of the factors that's driven earnings in the S&P has actually just been from a fairly small number of shares that have benefited from the AI theme. In addition to that, we've also had a US economy that's been quite strong despite fairly aggressive rate hikes over the last few years. And I think one of the key drivers of that, or that resilience in the economy, has been the fact that unlike other countries, US mortgages are fixed for 30 years. So although new mortgage buyers would have to pay up quite a bit for a new mortgage, the bulk of US mortgage holders actually have not been affected by current rates, given that they are locked in for 30 years. So this has really dulled the effect of these aggressive rate hikes that we've had. It's obviously a headwind going forward, but in the near term, it protects consumers from these aggressive hikes. Moving on to China, what I'm showing you here is a slide of the property cycle for a number of different regions in the world. And what you'll see is from the period from peak property prices to trough property prices has generally been about 6 years. China has only been going down for about 2.5, so there's still quite a bit of time left for them. What you don't see here in this chart, which is even more important, is the fact that valuations of Chinese property are still extremely elevated. Whether you look at that as a rental yield or you look at that as a house price to average income, they are extremely extended when we compare them to other countries in the world. This obviously weighs on consumer sentiment, which is a negative for the economy. Now, I mean, it's important to bear in mind that although Chinese growth has been lackluster and it's been coming down, it's certainly not falling off a cliff. And as a result, we don't expect there to be any significant stimulus from the government. In addition to that, exports have actually been holding up the Chinese economy by quite a substantial margin. And there's obviously a risk around exports in terms of tariffs. And you're obviously seeing a lot more news around that. Depending who gets voted in the US election, we might see something even more dramatic on that front. And that's obviously a worry for China. The only positive for Chinese assets is that they are cheap relative to history. And in addition to that, there are some very well-run Chinese businesses. And in particular, in SA, we can get exposure to Tencent via Naspers and Prosus. So we're not expecting much of a benefit to commodities from China at this stage. However, we are seeing a basing out in the manufacturing confidence index, and in manufacturing. It's been quite lackluster across the world. We're seeing signs of positivity emerging in emerging markets. Hasn't been quite as buoyant in Europe, but hopefully we do see some bottoming up and some continuation or some uptick here, and that would be positive for commodities, and that's obviously good for South Africa. There's also quite a correlation or reasonable correlation between manufacturing globally and emerging markets, and that obviously matters to South Africa given that we are part of that emerging market stock index. In addition to that, it would also provide a bit of support for the rand, which should also be good for SA assets. Here's a chart that I've shown before, and it really looks at the relationship between gold and real returns on US bonds. Just bear in mind that the right-hand side, which is real returns for US bonds, is inverted. And really the theory behind this, or the reason for this inverse relationship, is that as rates on US bonds increase, investors would rather buy US bonds and sell down gold. Now that relationship, as you can see in the last few years, is actually broken down, and we think that relates to geopolitical tensions, in particular the war in Ukraine and Russia. We had a freezing of Russian assets, and as a result, it's not just Russia, but other emerging markets are obviously concerned about having their reserves frozen, so they don't really want to buy dollars or euros. The alternative is gold, and that probably explains why there's been such a surge in central bank buying of gold in the last 2 years. If we look at central bank holdings of gold for emerging markets, they are especially low if you compare them to the developed world. So we think this is a theme that is likely to continue. Looking here at valuations for SA assets, and here I'm showing SA banks, what you can see, as I mentioned earlier in the presentation, that a lot of that extreme risk premium that we saw in SA assets was taken out post a positive election result. So valuations much closer to long-run averages. Important to bear in mind that the period that we're looking at here is one of anemic growth in SA. Should we get delivery from the government, it's quite possible that we actually trade at higher valuations than we've traded at over the last 10 years. If we look at SA bonds, which also can have a positive impact for shares or for valuations of SA assets should our bond yields come down, we break them up into 3 components. The first component is US real yields, the credit that you pay on SA dollar bonds, and finally an expected inflation rate. Now we've seen credit spreads pull in quite a bit. Expected inflation discounted into bonds has remained fairly stable. Where we think you could get a bit of a benefit is in terms of US real rates that could come down, given that we are expected to go into a cutting cycle. So that could provide some support for SA bonds, and that could indirectly provide some support for SA listed shares as well. Now there have been a few positive factors that have arisen post our election, and there are obviously some factors or some delivery that we're still waiting for. In terms of positive things that we're already seeing, one would obviously be electricity. We're already seeing energy availability much better than it's been historically. Separation of electricity from minerals and energy is clearly positive, and more private sector involvement has also been good. In terms of home affairs, we are finally seeing some action in terms of the backlog of visas for tourists and for skilled workers, which should definitely help economic growth in SA. And then we would expect rates to be cut. You're seeing rates being cut in the US, so we expect them to be cut over the next year. That'll make it easier for our Reserve Bank to cut rates as well. That should be a benefit to consumers, and the two-pot system should probably provide some benefit, at least in the short term. In terms of factors where we're still waiting for delivery, but where we have seen some positive movement, would be Transnet. We have a very capable new minister in that department, and we're seeing a lot of keenness to involve the private sector, which hopefully will bode well for transport in SA. This could be a key driver of GDP improvement In terms of water, it remains a priority for Project Vulindlela. There are obviously a lot of very skilled individuals involved in that. And then finally, in terms of the grey list, there's also been quite a lot happening in terms of getting us off the grey list next year. You would have heard the Minister of Finance speaking about that a few days ago. We are seeing some high-profile arrests in VBS, which would certainly help our case for being removed from the grey list. Moving on to asset allocation. In terms of our offshore exposure, we still maintain a reasonable exposure to offshore bonds, in particular short duration credit, where you get great yields of approximately 6.6%. That's the average running yield for our portfolio. We remain underweight some of those large US caps, which have fairly high valuations and a lot of frothy expectations built into them, and we remain more overweight in Europe, where we're seeing a lot more value. We still like a lot of offshore exposed shares that are listed on the JSE, in particular the likes of Anheuser and Bidcorp, which we think are offering good value at this stage. In terms of mining and resources, we expect copper deficits over the medium to long term, and that should certainly be good for some of our diversified SA shares like Anglo American and Glencore that have a lot of copper exposure. We also think, given that geopolitical tensions are likely to continue, and we think that you are in an interest rate cutting cycle, those two factors should be beneficial for gold and gold miners. We still remain positive on financials. We have reduced a bit of our exposure here, given the rally that we've seen, but you're still getting great dividend yields from many of the financials. There have been quite a number of domestic industrials that didn't run post the election, and we still remain exposed to those, the likes of Pepkor and some of the small cap shares. And then finally, in terms of SA government bonds, we still maintain a fairly sizable weighting here. We still think these yields of about 10.8 are compelling, which is roughly around the 10-year area. This is the overall asset allocation for the fund. With that, thank you, and I will hand over to Anil.